With mortgage rates as high as they are right now and home prices as high as they are right now, it's essential that you get the lowest mortgage rate possible when you buy a home. But how do you make sure you're getting the lowest rate possible? Well, I'm going to show you the 3-step process I go through with my clients to make sure they're getting the lowest mortgage rate possible when they buy a home with me. This saves my clients up to $50,000 in interest payments on a median California home. Though this technique works everywhere in the US, not just in California. My colleagues in lending hate me for sharing these secrets, but that's what I do. I'm Jon Schwartz, the 1% commission California agent, and my mission is to keep California home buyers from getting ripped off. Learn more on my website, jonsch.com. That's JONSCH.com. So before we get to the secret techniques, we have to talk about lenders, because there are different kinds of lenders, and it's important that you understand the basics before we get into the weeds. I divide lenders into 3 categories. The first kind of lender is a mortgage broker, and a mortgage broker acts as a middleman between you on one end of the transaction and lenders on the other end of the transaction. Mortgage brokers connect borrowers with wholesale lenders and take a small piece of the transaction for themselves. Generally, mortgage brokers are great because they're flexible, they're accessible. Mortgage brokers, whether they're working for a larger brokerage or have their own shop, mortgage brokers tend to work on commission, so they're hungry to get the deal done, which means they're going to work very hard for you. And generally, even though mortgage brokers earn a commission and take a commission from the deal, they tend to offer the lowest rates, and I'll explain why in a second. Number 2 on the list are mortgage banks, and these are large financial institutions that make all of their money writing loans. They're like banks, but just for loans. Now, mortgage banks have employees called mortgage officers who actually write the loans, so instead of working with a broker, you're dealing with an employee of the bank. So for that reason, mortgage banks tend not to be as flexible as brokers because you're working with an employee who probably clocks out at 5 p.m. and you won't be able to reach them in the evenings or on the weekends. And even though a mortgage officer at a mortgage bank is not taking a commission, he or she is still getting paid. So the rate might be just a touch higher to account for that additional overhead, which means that mortgage brokers and mortgage banks offer rates that are actually very competitive. And number 3 on the list are depository banks and credit unions. Depository banks are banks where you also have like a checking or savings account where you deposit money. So think of like the big banks, Wells Fargo, Citibank, etc. A lot of these big depository banks also have loan departments. And right alongside the depository banks, you have credit unions, which are also depository banks, but they're a slightly different category because of their small size. Credit unions are especially interesting right now because they offer adjustable rate mortgages, which have become more popular as rates have remained high. So you have mortgage brokers, mortgage banks, and depository banks and credit unions. Now, what's interesting about all 3 of these kinds of lenders is that whether they announce it or not, they all have flexibility in the rates that they can offer, and that's what you need to exploit. So let's jump into the 3 steps to make sure you're getting the best mortgage rate possible. Step 1. Get pre-approved. Now, being pre-approved by a lender means sending them your tax returns so they can verify your income and submitting to a hard credit pull. Now, a hard credit pull dings your credit score. You'll see a drop in your credit score of maybe 6 to 8 points when you do a hard credit pull. Fortunately, though, the credit bureaus are smart enough to know when you're shopping around for a specific kind of credit. So if you do several credit pulls at once for the same kind of credit, i.e. a home mortgage, the credit bureaus will know your comparison shopping and will only ding you once. And I believe the window is 45 days, meaning in a 45-day window, you can get pre-approved for as many loans as you want, and your credit score will only be dinged once. To play it safe, though, I would recommend that you get all of your pre-approvals done in a 2-week span of time. And when I say get all of your pre-approvals done, I mean, yes, get pre-approved by more than one lender. My blanket recommendation is to call your own bank and see what they offer. Oftentimes, banks will give you a slight discount on your mortgage rate if you have auto pay set up from your checking account at the bank, so that's worth checking out. I also recommend finding a mortgage broker through a referral or through a good real estate agent. Also, check out your local credit union. Reach out to a couple of lenders and get pre-approved by 3. If you want to get pre-approved by like 4 or 5 or 6, that's fine. So I guess I mean get pre-approved by at least 3. Like I said, make sure you do all of the pre-approvals in a 2-week window. Now, the outcome of the pre-approval, what you'll get in return is a pre-approval letter. Be sure to get a letter from each lender who puts you through the pre-approval process. Now, you'll need this letter when you submit an offer, and it's important to keep in mind now, you only need one pre-approval letter to accompany all of your offers, and you don't have to use that lender if that offer gets accepted. So get pre-approved by 3 or more lenders, get letters from all of them so you have the pre-approval, then take whatever letter is most attractive and use that for all of your offers, and you're not tied to using that lender, even if you use that lender's letter with your offers. All right, step number 2, find a home to buy. This is where someone like me can come and help you find a home to buy, though really you don't need a real estate agent these days to help you find the home. Redfin and Zillow, they both syndicate everything from the MLS. They both have great user interfaces. So you can go on either, create a search by literally drawing the area you're interested in, putting in your price points, putting in some must-haves, and saving the search such that the website will email you whenever a new property that meets your criteria comes to market. That's why, even though most agents are still charging the 2.5% commission that we've been charging for a decade or 2 or 3 now, I've reduced my commission to 1%, which is really all an agent needs to help you with the part of the process that you need an agent for, the actual buying of the house. And when your agent takes less of the deal, it means you're putting more money toward the offer, putting more money in the seller's pocket. That allows you as the home buyer to offer less and save a lot of money, or have a more competitive offer in a competitive situation. Learn more about writing stronger offers and saving tens of thousands of dollars on your California home purchase at my website, jonsch.com. That's JONSCH.com. Once you've found a home and you're working with a good agent who writes you a good offer and you get your offer accepted and you go into contract, now it's time for step 3. Pit your lenders against each other. Okay, the timing of this is very important. Once you go into contract on a home, you have about 2 days to choose a lender. Now, like I said, you don't have to use the lender whose pre-approval letter you used when you made your offer. But on a typical 30-day escrow, you have about 2 days to determine what lender you're actually going to move forward with in order to hit the deadlines that exist within that 30-day escrow. And if you've agreed to an accelerated escrow, like a 25 or 21 or even 17-day escrow in order to win the offer, you have even a shorter window during which to choose your lender. So you really need to get to work on step 3 right away. Obviously, if you're working with me, don't worry, I'll coach you through this. We'll hit our deadlines. So here's what you do. As soon as the seller accepts your offer, you send the executed contract to the lenders who have pre-approved you. Now, the executed contract is a contract that's been signed by both you and the seller. It's in effect. It's been executed. You take that document and you send it to the lenders who have pre-approved you. And what you do is you ask each lender for their best loan estimate. And that is a specific document. I'll show it to you right now. Okay, so this is a loan estimate. This is a loan estimate for my last home purchase. When you ask for a loan estimate, it doesn't mean, can you estimate what rate you'd be able to give me? Or can you estimate what the closing costs would be? What you want is this specific document called a loan estimate. This is sometimes also referred to as a initial disclosure. And this loan estimate has 2 numbers that you want from each lender so that you can compare them apples to apples. The first number right here is the interest rate. You don't want to be told an interest rate. You want to see it printed on paper on the loan estimate. And the other number you want to see is right here at the top of the second page, the loan costs. There are a lot of costs listed on page 2. You have these services you cannot shop for, services you can shop for, other costs, etc. These are mostly just estimates for now. But what you want to get from the lender is their origination charges. This is what the lender is charging you for the loan. And these can vary wildly. Some lenders will offer you a very low rate, but their origination charge is going to be in the thousands, 5, 6, 7,000. Other lenders are going to give you a slightly higher rate, but their origination charge is going to be low. $1,400 is relatively low. And you want to see both these numbers in the actual loan estimate. Tell each lender that you've just gone into contract, you're choosing a lender today, and you need their best loan estimate in order to make that choice. Now, this last step takes a little bit of backbone, a little bit of courage, because some lenders might actually call you. They're going to want to know what other lenders are offering. You do have to be a bit of a shark for just this one day, but it's worth it. Again, on a median California home, if you can get your rate down just 1/4 of a point, you're going to save yourself $50,000 in interest over the lifetime of the loan. If you'd like to work with a California agent who arms you with tactics like this to save you real money on your home purchase, you can schedule time to chat with me, no pressure, no commitment, at my website, jonsch.com. That's JONSCH.com. Subscribe for more helpful videos for California homebuyers, and check out my new expose on the California Realtor grift, stealing hundreds of millions of dollars from California homebuyers every year.